Warren Buffett just stepped down as CEO of Berkshire Hathaway. But before he left, he did something he has never done in his entire 60-year career. He sold half of Apple, dumped 77% of Amazon, and accumulated the largest cash position in corporate history, $382 billion. That's not a retirement plan. That's a warning. When the most disciplined capital allocator in modern history stops buying stocks and starts hoarding cash at this scale, you don't dismiss it, you decode it. And here's the problem with most of the coverage around this story right now. Everyone's asking, is Buffett predicting a crash? That's the wrong question. Because Buffett doesn't predict crashes. He positions for structural breaks. And the structural break he's preparing for isn't just stocks going down. It's something deeper. Something we've been tracking on this channel for months across silver, Bitcoin, and the banking system. So in the next 12 minutes, we're going to do 4 things. First, I'll show you exactly what Buffett did in his final quarter as CEO. Not speculation, the actual SEC filings. The numbers are insane. Second, I'll explain why his cash hoard isn't about market timing. It's about liquidity positioning, and why that distinction is everything. Third, the part nobody else is talking about. I'll connect what Buffett is detecting to the same fracture lines showing up in physical commodity markets, regional banks, and crypto simultaneously. And fourth, I'll give you the exact framework for how to think about your own positioning right now. Not panic selling, not blindly copying Buffett, understanding the signal. By the end of this, you'll know exactly what the $382 billion cash pile is measuring, and how to position accordingly. Let's start with what actually happened, because the headlines don't tell you the full story. On January 1st, 2026, Warren Buffett officially stepped down as CEO of Berkshire Hathaway. He handed operational control to Greg Abel. But in his final quarter, Q4 2025, Buffett executed a series of moves that left Wall Street confused and Reddit panicking. Here's what he did. He cut his Apple position by another 4%, bringing Berkshire's total reduction to over 50% since the start of 2024. Apple was Berkshire's largest holding, over $174 billion at its peak. Today, $62 billion. He cut it by 2/3. He slashed Amazon by 77%. A position originally bought by one of his deputies in 2019, Buffett essentially exited. He trimmed Bank of America again, bringing the stake down to just 7.1% ownership. This is the 3rd consecutive quarter he's been selling BAC. And he did something almost nobody noticed. He bought 5 million shares of the New York Times. Not Apple, not Google, the New York Times, a legacy media company trading at a fraction of big tech valuations. What does this tell you? Buffett is rotating out of the Magnificent Seven concentration, the AI-driven tech bubble, and into cash, treasuries, and legacy defensive assets. But here's the number that matters most. Berkshire's cash and treasury position now sits at $382 billion. That is larger than the market cap of Costco, larger than Disney, larger than Pfizer. It's the single largest corporate cash hoard in history, and it's growing. Now, here's where the mainstream analysis goes off the rails. Because most of the coverage says, Buffett thinks stocks are overvalued, so he's selling. That's only half true. And the half they're missing is the one that connects to everything we've been tracking. Before we get into what Buffett is actually detecting, and this is critical, you need to understand the difference between market timing and liquidity positioning, because they are not the same thing. Market timing is saying, stocks will crash on this date, so I'm selling everything now. Liquidity positioning is saying, I see stress building in the system's access to capital, so I'm rotating into the most liquid assets possible before that stress becomes a crisis. Buffett has never been a market timer, but he is an exceptional liquidity positioner. And right now, what he's positioning for is a liquidity freeze, not a market crash. Here's the difference. In a market crash, prices drop, but transactions still settle. Sellers can still sell, buyers can still buy. The market still functions. In a liquidity freeze, access disappears. The bid vanishes. Transactions stop settling on time. The plumbing breaks. And when the plumbing breaks, it doesn't matter what the price on your screen says, because you can't access it. Buffett's $382 billion isn't just cash sitting idle. It's almost entirely parked in short-term US Treasuries, the most liquid financial asset on Earth. This is not waiting for a dip. This is preparing for a system where liquidity becomes the only thing that matters. Now, here's where this gets interesting. Because the same signal Buffett is detecting in the stock market, it's showing up in 3 other places simultaneously. And we've covered all 3 on this channel in the last 60 days. Signal number 1, the physical commodity markets. We covered this extensively with the silver breakdown. Paper price says $80 to $90. Physical price in Dubai and Tokyo, $130. That's a $40 to $50 spread. That's not a dealer markup. That's a liquidity freeze in physical assets. The paper market, futures contracts, ETFs, unallocated accounts, is creating synthetic supply. But when buyers demand physical delivery, the system can't fulfill. There are over 250 to 350 paper claims for every 1 deliverable ounce. Buffett isn't buying silver, but he's detecting the same fracture. Paper claims on a physical reality that can't support them. Signal number 2, the regional banking system. Large banks like JP Morgan are reporting record profits, flush with Fed liquidity. Regional banks? Quietly absorbing commercial real estate losses, tightening lending standards, stress testing their deposit bases. Buffett's Bank of America trim isn't about BAC specifically failing. It's about the banking system bifurcating. And when that bifurcation accelerates, liquidity disappears from the parts of the system that touch real people. Signal number 3, the Bitcoin and crypto settlement layer. Bitcoin is being pulled in 2 directions simultaneously: institutional legitimacy via ETFs and sovereign adoption, and risk-off selling during macro turbulence. Buffett famously hates Bitcoin, but he's positioning for the exact same thing Bitcoin was designed to solve: a world where counterparty risk and settlement failure make liquidity more valuable than yield. So what do all 3 signals have in common? They're all detecting the same thing: a widening gap between what the system promises on paper and what it can actually deliver in reality. And when that gap closes, and it always closes, the repricing is never gradual, it's violent. This is what Buffett is preparing for. Not a 20% stock market correction, a systemic repricing of what liquidity actually means. Now, here's the question everyone on Reddit is asking. And it's the wrong question, but I want to answer it anyway because it matters. The question is, should I sell everything like Buffett and go to cash? The answer is no, and here's why. You are not Warren Buffett. You don't manage $382 billion. You don't have access to private deals at distressed prices during a crisis. You don't have a phone line to the CEOs of every Fortune 500 company. Buffett can afford to sit in cash for 5 years waiting for the perfect opportunity. You probably can't. But here's what you can take from his positioning. First, check your leverage. Buffett's 10th commandment of investing, which we covered in the Babson video, applies here. Don't buy on margin. The investors who got destroyed in every liquidity freeze weren't wrong about good assets. They were wrong about their leverage when the system lurched. Second, hold assets with real settlement finality. Not just paper claims, physical commodities, self-custody Bitcoin, cash in treasuries, not just bank deposits. Assets where you control the access, not a counterparty. Third, understand the difference between price and liquidity. Buffett isn't saying stocks are expensive. He's saying when liquidity disappears, expensive stocks become impossible to sell at any price. That's a different risk. And fourth, watch the same fractures Buffett is watching. Regional banks, physical commodity premiums, the gap between what the S&P is doing and what the internal market breadth is showing. These are not crash signals. They are stress signals. and stress conditions reward the liquid, not the leveraged. So where does this leave us? Warren Buffett built a $382 billion cash position because he sees a system where paper promises are diverging from physical reality, where the billboard says everything is fine, while the plumbing says otherwise. He's not predicting when the break happens. He's positioning so that when it does, he controls the asset the system will need most: liquidity. The Hindenburg omen detected bifurcation in stocks. Buffett detected bifurcation in everything. And the convergence of those signals, stock splitting, bank splitting, commodity splitting, crypto splitting, that's not noise. That's a system under systemic stress. You can't time the break, but you can absolutely position for it. Reduce leverage. Hold real assets. Watch the fractures. Because when the paper market is forced to confront physical reality, the repricing is never slow. It's sudden, and it's violent. Buffett knows this. He's been through it multiple times, and his final move as CEO was to prepare Berkshire for the next one. The question is, are you? Here's what I want to know. Drop it in the comments. Where do you see Buffett's signal showing up in your own financial life right now? Your portfolio, your bank, your employer, your city. Because the most valuable intelligence isn't what Buffett's doing. It's what you're seeing from the inside that the headlines are missing. And if you want to keep tracking the fractures across stocks, banking, silver, Bitcoin, and liquidity as they develop in real time, subscribe. Because the next video connects this directly to something happening inside the Treasury market that could trigger the exact liquidity freeze Buffett is positioning for. You don't want to miss that one.